Stuart, we're back here for another episode. Thanks so much for joining me today. We're going to talk a little bit about the elections are finally over.
The elections are over, and I know everybody feels the same way, that they're glad not to have, 100 text messages a day and,
I got so many spam messages.
phone calls coming in. So, yeah, it's nice that it's over.
But with it comes now maybe some certainty and maybe some uncertainty, right? Depending on some of the feelings or now that Trump's elected again, where are we going to go and what kind of policies are they going to put in place? He's gearing up to make some serious changes, it sounds like, with the Doge and the group that's going to be looking at government efficiency. So for our listeners, I want to talk, under that context, what now, right? The election's over, all the chaos that built up, regardless of what side of the political aisle anybody's on, what's next? What should people be thinking about? How is this going to impact the future?
Yeah, and I look, I think it's very timely, obviously, conversation to have, and I know in one of our previous episodes we talked about that, we don't think about planning, financial planning, in 4-year windows of time, right? We're thinking about this 5, 10, 15, 20-year, periods of time. And, what really is on my mind, as we go into 2025 and a new administration, and it's going to be interesting to see how this all kind of plays out and the team that's built and, just the ability to get things done, are taxes, and this is a subject that does not go out of style. It's one of the things that we talk about in most of our episodes. We are all about, disinheriting the Internal Revenue Service, right?
Yeah.
Teaching our clients, showing our clients, reminding our clients that we believe paying the absolute legal minimum due is just a prudent thing to do, right? Keep more of your money in your pocket. And again, we just had a previous episode where we talked about charitable giving and using a donor advised fund to kind of marry, charitable giving with tax planning. But, this new year coming up reminds me to remind our listeners about some of the subjects that we talk to our clients about, which is tax management and tax location planning. So I think most people are aware of asset allocation, right? And asset allocation, of course, is you have a portfolio. How much should you have in stocks? How much should you have in bonds? How much should you have in cash? What is your allocation, right? How much money should be, at-risk money? How much money should be safe money? I mean, you can look at it differently. Tax location planning is very, very different, and it's a framework that we want to get into conversations with our client about, which is looking at what they have now. So how much money do they have in taxable accounts? How much money do they have in tax-deferred accounts, IRAs, 401ks? And how much money do they have in tax-free accounts? Okay? Like Roth IRAs as an example.
Yeah.
Life insurance, properly structured for tax purposes. And this conversation, as we talk to our clients about building out a future income plan for them, is very, very important. Because at the end of the day, if you had a choice, where do you want your biggest bucket to be? In taxable accounts, tax-deferred accounts, or tax-free accounts? I think it's a unanimous decision. You want all of your money, or the majority of your money, to be in tax-free accounts. Because what we don't know is what the future is going to be, right, when it comes to taxes. So maybe over the next 4 years, taxes will stay the same. Maybe they'll go up a little, maybe they'll go down a little bit, but over time, we know that taxes are going to continue to go up, whether it's by eliminating deductions or whether it's raising other areas of our tax code, if you will. But tax location planning is a conversation that we want to get into our clients about so we can make sure that they have the proper diversification in those three different areas or buckets, if you will.
So for those people that, I mean, you guys are doing this with your current clients, but for the listeners that are listening to this that maybe aren't currently working with you and are sitting there saying, Stuart, that sounds great. What do I do? What does that mean for me in 2025? What do I do? How do I do that asset location or tax location planning?
So again, I mean, look, it requires a conversation. This is not a DIY type of a thing. And, you know, it's really about sitting down with somebody, whether it's face-to-face or whether it's over a Zoom call, because we do have clients all over the country, and talking about where they are now. Okay, let's look at what you have now. How much money's in tax-deferred accounts, how much money's in taxable accounts, and how much money's in tax-free accounts, right? So that's where you are now. Where do you want to go? Well, still, I want to retire in 5 years. I want to retire in 10 years. Great. When you retire in 5 years or 10 years or whatever that is, what do you want that to look like? Well, I would like to have, you know, 200,000 of income when I retire, okay? Or 300,000 or 400,000 or 80,000, whatever the number is, that's the number. Okay. So now we need to put together a plan, and look, the sooner that people do this, the better. This is the magic of time and compound interest and being proactive. One of the big things, James, that we do, and any competent financial advisor does, is we come from a place of being proactive, okay? Not reactive. And again, I'm not, you know, bus rolling any accountants as an example, but accountants, generally speaking, are reactive, meaning a client brings their tax stuff to their tax person in January or February for 2024. So in January, February, March 2025, they show up with all their information for 2024. Is there any tax planning that can be done? Not really.
Oh, it's over.
Maybe you can still make an IRA contribution if you're eligible. If you're a business owner, maybe you can still make your SEP IRA contribution before you file your tax return. Maybe there's some things, but not some real planning, if you will. So coming from a reactive standpoint, there's not much you can do. Coming from a proactive standpoint, you know, like this is why we talked about a donor advised fund on one of our recent episodes and whatnot. The perfect time now, as you're doing, that has to be done by December 31st.
Yeah.
If you want the tax deduction for 2024, right? So again, it's just a matter of being proactive versus reactive. And this is what we bring to the table. So
I love that. Ultimately, for those that are looking at 2025, again, there may not be a whole lot that you can do for taxes from 2024, but there's a whole lot that you can do for taxes in 2025 for the 2026 season by sitting down with Stuart and his team in the office and let them analyze the situation and help you understand where your money currently is, whether it's currently taxable, tax deferred, or tax free, and then creating a plan on how to manage that and diversify it so that you're well protected going into retirement.
yeah, James, and one of the other things that we see all the time is, you know, clients that, or prospects, if you will, that we're meeting, whether they, you know, come to us via one of our dinner programs or they connect with us via social media or whether under the 72-tier professor, you know, people who have not taxable investment accounts. So in other words, non-IRA investment accounts, right? Taxable brokerage account or a taxable fee-based account. What I see 95 times out of 100, okay, is that they or whatever advisor they are getting advice from are not managing that money in a tax managed basis. So we call that tax management, okay, on your portfolio. If it's IRA money, there's no tax management in an IRA, right? It's non-IRA money that I'm talking about here. What we know is, okay, from the work that we do, we are saving our clients somewhere between 1 and 3% a year in tax savings. So if somebody has a $500,000 portfolio, we're saving them somewhere between $5,000 and $15,000 a year in basically tax savings
Wow.
by the work that we're doing from proactively paying attention to the ongoing tax management, utilizing all the different techniques that we use, whether it's tax loss harvesting, gain loss offset, and on and on and on, to basically let our clients not sacrifice return, but again, to save on taxes.
I don't know why anybody wouldn't want that. I mean, it seems obvious, but
Well, again, I think most people, as a matter of fact, I know most people are unaware that this can even be done. Why other advisors are not talking to their clients about it, I have no idea. Why Fidelity and Vanguard and Schwab aren't talking to their clients about it, I have no idea. Look, we do a lot of business with Schwab. We do a lot of business with Vanguard and, and Fidelity. I mean, we use their funds. We use their ETFs. I mean, we're product agnostic. Those companies are just manufacturers of product, if you will. They have funds. They have strategies, right? But they are not, other advisors that we see are not talking to their clients about disinheriting the IRS. How can we plan so year in and year out, you're giving the tax man less money and keeping more of that for yourself and your family?
well, again, reach out, schedule. It's free. It's a free consultation. It's a free sit down with you and your team to have a free second opinion.
Awesome.
Stuart, thank you so much.
Thank you, James. Have a great day, my friend.
We'll see you on the next one.